Welcome to our next reading on financial reporting standards. Bit of a caveat up front, this isn't the most interesting of areas or technical of areas, but nonetheless you are likely to see questions on it in the exam. So try and make it through, use matchsticks to prop your eyes open or whatever you need. Okay, let's start with our first learning outcome. So our first learning outcome is to describe the objective of financial statements. And to do this, we're going to look at the International Accounting Standards Board's conceptual framework, first published in 2010. Okay, well, notice it says the objective of general purpose financial statements is to provide financial information about the reporting of entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. Okay, so let's sum that up. What we're really saying is the accounts are not purely aimed at the existing shareholders. In fact, it's not just shareholders at all. We're talking about everybody that provides credit to a company. So we're talking about shareholders, we're talking about people that are bondholders, we're talking about banks that give loans, and we're talking about any other creditors like suppliers, like tax authorities. And notice as well, we're not just saying existing, but we're also talking about potential investors. So those that are thinking about buying, selling, or holding debt or equity instruments. This just gives us a little overview about how the system works in the US. You can see in our middle box there, we've got the Financial Accounting Standards Board. And the Financial Accounting Standards Board, they're responsible for setting out the statement of financial accounting concepts. In other words, this is the framework of concepts that we're going to use to build accounting standards. And we're going to have a look at one later, in fact, the IFRS version of this. And you'll notice they also publish statements of financial accounting standards. If you like, these are the detailed rules about how you'll treat each different classification of accounts type in the financial statements. So we'll see rules on, for example, revenue recognition popping up in the statements of financial accounting standards. Now you'll notice above that we have the American Institute of Certified Public Accountants and the Securities and Exchange Commission both recognizing the importance of the Financial Accounting Standards Board. In other words, let's take those American Institute of Certified Public Accountants. These are our auditors, essentially, in the US. And what they're really saying here is in order for them to give you a true and fair, clean audit report, you're going to need to comply with the statements of financial accounting standards as set out by the Financial Accounting Standards Board. Again, the SEC, responsible for looking after listed companies, stock exchange listed companies. Again, setting out here that they recognize as well the Financial Accounting Standards Board. In other words, if you're a listed company or you want admission to an exchange, you're also going to have to comply with the statements of the statements of financial accounting standards. Okay, so the two major accounting regulations that we see are those set out by the Financial Accounting Standards Board, i.e. US GAAP, and those set out by the International Accounting Standards Board, i.e. International Financial Reporting Standards, otherwise known as IFRSs, or IAS, International Accounting Standards. So we actually hit our next LOS that says describe the importance and the desirable attributes of standard setters. So again, unfortunately here we've got a list to learn. So let's just take them one at a time. Observe high professional standards. Yeah, clearly we want our regulators and our standard setters to be ethical. They need to have adequate authority, resources and competencies to accomplish their mission. So authority, in other words, people will listen to them and they can enforce. Resources, in other words, they have the financial resources to complete the job that they're undertaking, and competencies, they have the skill set to accomplish their mission. Now, what is their mission? Coming up with an accounting framework and accounting standards to cover all financial transactions. Clear and consistent standard setting process. So in other words, there are rules and procedures that they go through when coming up with a new accounting standard, guided by a well-articulated framework. Now this simply says when they're coming up with new accounting standards, they go back to the accounting framework that gives them the ideas and the concepts that they're going to use to actually flesh out the accounting standard. operating independently while still seeking input from stakeholders. So in other words, they should be independent, which again is just really saying free from bias, but they should seek input from stakeholders. In other words, who are these stakeholders? They're all the users of the accounts. So companies themselves, creditors of companies, banks, tax authorities, etc. Not compromised by special interests. Well, again, you can see a potential conflict here. Number one, in the previous one, we said they should seek input from stakeholders. And now we're saying, look, they shouldn't be compromised by special interests. They shouldn't become biased towards the interests of one particular stakeholder group. And then the final one, decisions made in the public interest result in standards adopted by the regulatory authorities. In other words, we end up with a set of accounting standards that acts in the best interest of the public. Okay, again, we've just got a few additional regulators that we should be aware of. The Securities and Exchange Commission, they're the listing authority, of course, in the US. Financial Services Authority, they're the UK's listing authority. In other words, if you're going for an IPO, admission to an exchange, you're not only going to have to comply with the normal accounting standards that apply to unlisted companies, but you're also going to have additional detailed regulations from these two bodies. We should also be a little bit aware of IOSCO, the International Organization of Securities Commissions. Now, we'll see a bit more on IOSCO on the next slide. So the LOS here asks us to describe the role of IOSCO. So we certainly need to be aware that it's broad-reaching. Notice it covers 181 members, 90% of the world's capital markets. In other words, IOSCO contains the regulators of the financial markets. Now, we're asked about their role. Notice their goal is uniform regulation, but their core objective, their core role is really to make sure that we have well-functioning financial markets. And with that in mind, we've got three major core objectives. Number one, protecting investors. So in other words, protecting people transacting financially. Now, of course, typically when they look at protecting investors, they'll look to rank investors according to their skills. Those investors with no skills, i.e. the general public, are going to need greater protection than those that work in financial markets. We're going to try and ensure fair, transparent and efficient markets. So fair, what does fair really mean? Well, essentially that maybe the prices in financial markets represent all price-sensitive information. Transparent, all transactions are efficiently reported. And efficient, now of course we talk about efficiency when we look at the equity readings of CFA, and we often talk about informational efficiency, how fast the share price reacts to new information. One part you often see with listing authorities, for example, is the requirement of listed companies to release publicly or price-sensitive material information to the public as soon as possible. Why? To prevent an unfair market being established. And the final one is reducing systematic risk. Now, of course, when we talk about systematic risk, we typically talk about the risk of the business cycle fluctuations. Now, given the credit crunch and the global recessions that we're seeing, in particular in Eurozone countries at the moment, you might argue that they haven't been particularly successful at achieving point 3. Now, we've got a few SEC filing forms here. Now, again, it's one of these little areas where it's a little bit moot about whether the actual LOS covers this. But again, I think to be on the safe side, you should be aware broadly of the contents of these filings and forms. So the first one we get is S1. Now this, of course, relates to IPOs, initial public offerings. And you're going to find a lot of information in IPO filings, in particular on the finances of the company, business of the company, and really important for the analysts, the risks that the company faces. The 10K is the annual report. The 10Q are quarterly reports. Now, of course, if you're a US listed firm, then you're going to be reporting interim accounts quarterly. Typically outside the US, listed companies tend to report 6 monthly. Def 14A is proxy statements. Now, the idea here is shareholders must receive information on which they're likely to vote in the form of proxy statements. What does a proxy mean? Well, it gives the shareholder the right to have someone to vote on their behalf on these matters. So in other words, whenever the company has a meeting, and in that meeting there's going to be a resolution, i.e. a shareholder vote, these proxy statements need to be sent to the shareholders before. So the analyst could have a look at these proxy statements to see up and coming business within the company meetings. Now 8K is a very important one, material events. Remember what we said just a while ago, one of the goals of IOSCOs is to ensure efficient markets. Now markets are only going to be efficient if price sensitive information is released to the market in a timely fashion. And Form 8K is going to cover this. So it's going to contain all price sensitive material events to the companies. So for example, major acquisitions would be included, changes of auditors, changes of legal firms that represent the company, appointment and removal of directors you're going to see in material events, and in fact any other price sensitive information. Remember, any material non-public information should be released as soon as possible to ensure full and fair disclosure. In other words, to make the markets informationally efficient. Form 144, I'm not too excited about this one in all honesty. Notice it's stock issues to qualified buyers without SEC registration. It typically covers transactions between a company and its associates, otherwise known as affiliates. Now Forms 3, 4 and 5 are going to be far more interesting because these are going to include transactions, equity transactions, so share dealings with corporate insiders. Now what do we mean by corporate insiders? Well, obviously the directors of the company, key officers of the company, and also shareholders that have over 10% of a certain classification of shares. So every time they buy and sell, we're going to see that reported in Forms 3, 4 and 5. Our next LOS asks us to describe the global convergence of accounting standards. Now, of course, what does convergence mean? Well, it essentially means harmonization, reducing the differences between them. And we've seen an awful lot of work between US GAAP and international accounting standards to reduce the differences. Now, when I qualified as an accountant in the UK 20 years ago, there was a heck of a lot of differences between the two. These days, they're getting fewer and fewer and fewer. In fact, I hardly recognize the two in this day and age. So let's look at them. Why are they doing it is what we're asked to describe. Now, of course, increased comparability. If you've got two sets of accounts produced using similar accounting standards, it means, of course, the users of those accounts can actually pick up either set of accounts and understand them. So in other words, if I'm a UK investor used to seeing IFRS, if I pick up the accounts of a US company using US GAAP, I should be able to understand them. Why is increased comparability important? Well, of course, investors this day and age are making global investment decisions and holding global portfolios rather than just domestic. Second point, decreases problems and expense of raising capital in foreign markets. Now again, for the providers of credit, they're going to understand the accounts that you submit. And that, of course, reduces their risk. And if it reduces their risk, it should reduce the cost of raising finance. The third one is decreasing the problems and expense of preparing consolidated financial statements for foreign subsidiaries. So we're really talking about global companies, global entities with operations dotted around the world. Now, of course, each of these overseas subsidiaries is going to need to produce accounts in its domestic currency according to its domestic rules. So, for example, if I've got a US company with a UK subsidiary, that UK subsidiary is going to need to produce its accounts in line with IFRS. However, when the US parent produces its consolidated group accounts, it's going to need to take all of those subsidiaries' accounts and retranslate them to US GAAP before consolidating, i.e. combining them together. So, in other words, the closer the accounting standards are globally, the less time and expense they're going to incur converting overseas subsidiaries' accounts to the domestic rules. Now, we're also asked to be a little bit aware about the barriers to convergence. Again, we're asked to describe. So first of all, differences in view between standard setting bodies. Well, let's talk about a classic difference in view that we see between US GAAP and IFRS. US GAAP traditionally has been more rules-based. IFRS has been more conceptual-based, and it's been more interested in making sure that economic substance is reported rather than legal form. And there's always been a standoff between the two, although that is being reduced over time. Pressures. Now, of course, each accounting standard body is going to be lobbied by companies that operate within their country. And of course, that might mean they're reluctant to change or harmonize their accounting standards. And then finally, of course, we've got lots of different countries that are involved globally, each one with a voice. And of course, when you've got lots of different voices, it's hard to find a consensus. Now, our next LOS is quite an important one. We need to describe the objectives and the qualitative characteristics of the IFRS conceptual framework. Now, we talked about the objectives early on. Earlier on, we talked about the objectives being providing useful and relevant information for economic decision making. Remember, we said debt, equity holders, and other creditors, and we talked about people that were actually buying, selling, or holding both debt and equity securities. So that means we can turn our attention to the qualitative characteristics. Now, under IFRS, we have two qualitative characteristics. If you rewind a few years ago, there used to be four, but they've kind of condensed them down. So the two we need to be aware of in our exam are relevance and faithful representation. Now, we need to describe them, so let's start with relevance. What makes account relevant? Well, really what we're doing is we're looking at the users of the accounts here, and we're saying, look, accounts are relevant if they're useful for economic decision making. So let's have a look at our first bullet points. The information can influence users' economic decisions or affect their evaluation of past events or forecasts of future events. So in other words, the information in the accounts can be used for decision making. Let's go back to those objectives: buying, selling, or holding both debt and equity securities. So of course, when we talk about forecasts of future events, we see a lot of that, of course, in equity analysis, where we're using the accounts to provide information such as earnings, and then we're using the earnings in a valuation context, such as price multiples like the PE ratio. Notice information should have a predictive value, a confirmatory value, i.e. confirm prior expectations, or both. Materiality is an aspect of relevance. So what are we talking about here? Predictive value. In other words, let's go back to that equity valuation example again that we said. The idea that we can take earnings, strip out all of the one-off items, normalize for the business cycle, and then maybe use earnings to forecast future earnings, and then use it in a multiple context, such as the PE ratio. Other situations where we use accounting information for their predictive value, things like free cash flows, things like dividend valuation modeling. Okay, so we certainly use them for predictive value in terms of equity valuation and, of course, fixed income valuation. But we also use them to confirm our prior expectations. In other words, did the company meet its earnings per share target, its earnings per share forecast? Notice here we introduced the idea of materiality, and we saw materiality, of course, coming up earlier when we talked about the audit report. Materiality, remember, is deemed to be an amount that is sufficiently important to affect the users of the accounts. So let's move to our second qualitative characteristic, which is faithful representation. Faithful representation. Information that is faithfully representative is complete, neutral, and free from error. In other words, the accounts should represent the economic substance of the transactions that the company's entered into. It should be complete, cover all financial transactions that the company entered, neutral, so it should not be biased, and free from error. Goes back to this idea that material transactions should be free from error in order for the accounts to be true and fair. Now notice we have some sub-characteristics here. These aren't necessarily linked to faithful representation, but these will help our accounts be both relevant and faithfully represented. So comparability. Comparability allows us to compare year on year. So for example, the framework says you need to produce not just this year's figures, but you also need to state last year's figures so we can compare. It also makes it very difficult to change an accounting policy. In fact, if we change an accounting policy, we have to go back to prior years and restate those accounts as if that policy was used then as well. Verifiability. Now, of course, this links back to the audit. The numbers in the accounts should be verifiable. And, of course, it's the auditor's job to verify, normally on a sample basis, the figures in the accounts. Timeliness is really talking about how long it takes to produce the accounts, audit the accounts, and then finally publish the accounts. It's basically linked to the idea that the financial information goes out of date very quickly. In other words, it loses its relevance for economic decision making quite quickly. And understandability. Well, understandability just says a user with reasonable knowledge of business and economic activities should, with a little work, be able to understand the accounts. And when I say understand, really I'm saying they should be able to uncover the economic substance of the firm's position and performance over the previous period. So very important in the exam, certainly know the two qualitative characteristics and also know the sub-characteristics and make sure you do not get them confused. Now let's talk about constraints. Now obviously we'd like to have both characteristics, but in reality we do get trade-offs. So let's talk about relevance versus verifiability. Now relevance, of course, says we want the information in the accounts to be relevant for economic decision making. And of course that means very, very timely. The quicker the information comes out after the firm's year end, the more up to date that information is, the more useful it is in economic decision making. Verifiability says we should have verified the numbers in the accounts. Now hold on just a second. There's a lot of assumptions and estimates that are used in the accounts. Surely, therefore, the longer we wait after year end, the easier it will be to verify, due to post-balance sheet events, the figures in the balance sheet at the year end. For example, at year end, you've got your accounts receivable, i.e. your trade receivables, amounts owed by your customers sitting in your current assets. Now, of course, what we need to do is deduct the amount we don't think we'll be able to collect and put it through the income statement as an expense. Now, of course, at the balance sheet date, those customers might not yet be due to pay you. And as a result, you're going to have to estimate how much you can't collect. Now, if you wait post-year end, you'll know exactly how much you collected from those customers. In other words, it'd be much easier to verify the accuracy of your bad debt provision if you wait till after the year end. Problem is, the longer you wait, the older the information is, and it loses its relevance. Benefits versus costs, fairly straightforward point. The benefits, i.e. the relevance for economic decision making, should outweigh the costs of actually producing and auditing the financial statements. And then, of course, a key one, it excludes non-quantifiable information. All the figures in our primary statements, i.e. the balance sheet, the income statement, the cash flow statement, and the statement of comprehensive income, and the reconciliation of opening and closing stockholders' equity, it's all putting monetary values on these. In other words, we need to be able to put a monetary quantifiable value in order for it to be included in our primary financial statements. What that means is non-quantifiable information, of course, is excluded. Well, when we say excluded, it is, of course, to some degree discussed in the management discussion and analysis, but you should remember the management discussion and analysis is unaudited, unlike the primary financial statements and the footnote disclosure. Right, our next LOS. Describe, it says, IFRS required reporting elements. An item should be recognized in the financial statements, in its financial statement element, if a future economic benefit from the item flowing to or from the firm is probable and the item's value or cost can be measured reliably. Okay, let's just break that down step by step. Recognized means, of course, included in the financial statements. So we should include an item in our financial statements, i.e. our income statement or a balance sheet, if future economic benefit will flow to or from the firm. So let's take a sale on credit. We've made a sale on credit, we've recorded a sale, we've recorded accounts receivable. How do accounts receivable lead to a probable flow of future benefit? Well, of course, the customer should pay us, and at that time, cash, of course, will come into the company, a flow of economic benefit from that transaction. Likewise, if you look at liabilities where you owe people money, of course, a liability represents a flow of economic benefit leaving the company. Now, notice it should be probable, so it's likely to happen. And then the final point, that its value or cost can be measured reliably, i.e. we can put an accurate monetary value on this transaction. We can put it in dollars, pounds, euros, whatever we're using. So let's have a little look at our definitions, and really we're just taking that box that we looked on the previous slide and talking about it in terms of the balance sheet. So assets, resources controlled by the entity resulting from past transactions. So let's take our accounts receivable again as a classic example. You sell some goods on credit. Okay. And in your balance sheet, in your current assets, we're going to see accounts receivable, trade receivables, representing how much your customers owe you. So what was the past transaction? Well, the past transaction was that we sold goods on credit. What's the probable flow of future benefits to the enterprise? Well, hopefully our customers will pay us, and then hence we'll have cash inflows. That, of course, also is why we take the accounts receivables figure and we deduct the amount we don't think we're going to be able to collect based on past experience. If you're not going to be able to collect the cash from your customers because they're going to default, where's the flow of economic benefit? Liabilities, obligations resulting from past events. Now, of course, when these are settled, we get probable resource outflows. So an asset, an inflow of resources, a liability, an outflow of resources. Let's imagine that we've issued a bond. Well, the obligation is, of course, when we issue a bond, we're obligating to meet interest and principal payments over time. And of course, what are the flow of economic benefits? The flows of economic benefits are when we meet those coupon payments and those principal payments. Cash, of course, will leave the business. Now notice here we define equity as shareholders' residual interest. Think of assets as everything the company owns and everything the company is owed. Think about liabilities as all the amounts the company owes to third parties. So if we take all of the assets, deduct the amounts it owes to third parties, i.e. the liabilities, the remainder, the residual that we have left, of course, is what belongs to our shareholders. And we're going to call this our stockholders' equity. Let's turn our attention to the income statement. Now you'll notice IFRS just talks about income and expenses. Now when you contrast that with US GAAP, it talks about revenues, expenses, gains and losses and other comprehensive income. However, that's just definitional stuff. Really, notice their definition of income. It's really anything that will result in an increase in equity other than transactions with the shareholders themselves. So what's it really going to include, income? It's going to include enhancement of assets, decreases of liabilities, and revenues and gains. Enhancements of assets, things like asset revaluation that will be taken directly into our stockholders' equity. And of course, we refer to that as a comprehensive income item. So it includes comprehensive income, it also includes revenue, revenue of course classically being sales, and it also includes accounting gains when we dispose of assets and liabilities. So note, whilst it just refers to income being increases in economic benefits that result in increases in equity, actually it's very similar to US GAAP because it's actually including sales, gains and losses on disposal, and comprehensive income items. When we look at expenses, the same is true, a decrease in economic benefits. So notice outflows or reductions in assets, increases in liabilities, or expenses and losses in the income statement. Notice these all are items that decrease our stockholders' equity. Now, of course, the other side of the transaction is either hitting, when we talk about depletion of assets, the other side of the double entry is either in the income statement or directly in stockholders' equity within comprehensive income. So rather like income, we're actually talking about the expenses that directly go through the income statement, losses on asset disposal, but also changes in comprehensive income items. Now, if you're unaware of comprehensive income, don't worry just at this stage. We're going to cover that in a later reading. Now, our next LOS is asking us, or in fact the same LOS, it's really asking us to describe the general requirements of International Accounting Standard number 1. So first of all, let's have a look at these required financial statements. I don't think we're going to see any shocks here. You've got to produce a balance sheet. You've got to have an income statement. And of course, that income statement spans between last balance sheet date and this year's balance sheet date. You've got to have a statement of comprehensive income. Now, this has been a requirement under US GAAP for a number of years, but is relatively recent for IFRS. What is the comprehensive income? Well, we're going to see it later in more detail. It takes net income. It then takes all of the gains and losses that accrue to the shareholders that have been taken directly to stockholders' equity. In other words, some gains and losses, some income and expenses don't go via the income statement, they go via stockholders' equity directly there. Again, what items do and what items don't, well, we're going to look at that in a later reading. Changes in equity, the reconciliation of last year's balance sheet equity figure to this year's balance sheet equity figure. The cash flow statement, of course, that reconciles last year's cash figure to this year's cash figure. So those are our primary statements. We've then got all of our footnote disclosure, accounting policies, notes, footnote disclosure. So let's have a look at our fundamental principles. Fair presentation. So in other words, transactions and presentation should be fair. It should cover all financial transactions that the company has undertaken, and it should reflect their economic substance. Going concern simply says we will assume that the company will continue for the foreseeable future. If this wasn't the case, and we didn't have going concern, i.e. the company was likely to be liquidated, we wouldn't have things like non-current assets, because essentially all of the assets would be disposed of. We wouldn't have long-term liabilities, because all liabilities would be extinguished in the next operating cycle. So it makes a very big difference between how the balance sheet is essentially presented. Accruals basis, a key point. We're going to produce the accounts based on the accruals principle. What that means is essentially we're going to recognize revenue when the earnings activity is complete, providing we have reasonable assurance of payment. And we're going to match expenses or costs to the revenues. And of course, any cost that you incur that is not directly related to a sale is matched against time. What that means, of course, is we're accounting for transactions, not when the cash flows are paid and received. So there's going to be a key difference between income in the income statement and cash flows in the cash flow statement. Consistency is really saying we need to prepare the accounts consistently year on year. In other words, once you choose your accounting policies, we're going to make it very difficult for you to change them. In fact, we said if you do change your accounting policies, we're going to force you to go back to prior years and restate those as if those accounting policies were in effect in that year as well. Materiality really says that we need the correct accounting treatment for all material items. Now remember that definition of material. Material means would affect the users of the accounts. So what we're really saying is if an item was immaterial, we don't really care how it's been accounted for. Now let's have a look at our presentation requirements. Notice our presentation requirements, it says aggregation where appropriate. So let's take an example of that on the face of the balance sheet. So our aggregation, we're going to see, for example, one figure for accounts receivable, the amounts owed by our customers, rather than, for example, seeing the amounts owed by each customer separately. It's just consolidating or reducing the information on the face of the balance sheet to make it less cluttered. No offsetting really means we are not allowed to offset or net, if you like, assets against liabilities unless we have a legal entitlement to do so. So for example, imagine that you have a bank account that has positive cash in one bank and you have another bank account held with another bank that's essentially overdrawn, i.e. has negative cash. You wouldn't be allowed to show the two netted against each other. Why? Because they're held with different banks. You'd have to show one as an asset, one as a liability. We're going to have to show a classified balance sheet where we're going to classify assets according to liquidity. We're going to class assets according to use. We're going to have those that are held for use and those that are essentially held for sale, current assets. Same with liabilities. Our liabilities are going to be classified according to their type and, of course, according to their due date. Minimum information on the face. Well, this really goes to the idea that the accounting standards set out an absolute minimum amount that needs to be reported on the face of the financial statements. Now, companies, of course, can present more information if they like, but not less. They'll have minimum information on the face. The accounting standards then set out the minimum disclosure in the footnotes. Now, the disclosure in the footnotes is designed to give more information, of course, on the accounting information that you see in the face of those primary financial statements. So, for example, when you look at creditors, you might see a line in the balance sheet saying other creditors. When you turn to the footnote disclosure, it'll explain exactly what is included in those other creditors items. And then our final point here, comparative info. This is the requirement to produce not only this year's financial data, but last year's as well. So we have both the balance sheet for this year, the balance sheet for last year, same with income statements as well. Why? To enable comparison year on year. Now we're asked to compare US GAAP to IFRS. Now notice the first one that we've got here. ISB framework lists income and expenses as elements related to financial performance. Well, it did, but remember it talked about income and expenses as changes in stockholders' equity other than transactions directly related to the equity holders themselves. Whilst US GAAP includes revenues, i.e. sales, expenses that go through the income statement, gains and losses on disposals, and comprehensive income. Well, by definition, these all items would be the same as income and expenses in aggregate under IFRS. So all you're really saying is US GAAP is splitting out income and expenses into three classifications. Revenues and expenses that go through the income statement as part of your core day-to-day operating, gains and losses when you retire assets and liabilities, and comprehensive income, the gains to equity holders that have been, and losses potentially, that have been taken directly to the income, directly to stockholders' equity. Now again, the next point again is marginal at best. Notice US GAAP defines an asset as a future economic benefit. Now hang on a second. International accounting standards called it a resource from which future economic benefit is expected to flow. US GAAP also uses the word probable. So in other words, US GAAP is an asset from which a probable flow of future economic benefit is likely. Now hang on a second. International accounting standard says it's a resource where future economic benefit is expected to flow. Expected sounds a little bit like probable in my book. So whilst the wording is different here, the actual treatment is roughly the same. Now the third one is a key difference between US GAAP and IFRS. Notice US GAAP does not allow the upward valuation of most assets. IFRS is more flexible, allowing you to revalue things like plant property and equipment and intangibles. US GAAP typically does not allow the upward valuation of assets. There are exceptions to this rule under US GAAP, in particular financial instruments such as available for sale and trading securities that we're going to encounter in a later reading, and also any assets that are hedged using derivatives are essentially marked to market in the balance sheet, i.e. recorded at their fair value and therefore are allowed to be valued. But US GAAP does not typically allow you to revalue your plant, property and equipment and intangibles. International accounting standards does. Right, identify, it says, the characteristics of a coherent reporting framework. So 3 to be aware of: transparency, comprehensiveness, and consistency. Now your typical question is going to be, which of the following is a coherent characteristic of a coherent reporting framework? So again, it's rote learning, I'm afraid. But let's try and define each one of these in turn. Transparency. The accounts reflect economic substance. Okay, remember what we mean by economic substance. It means that the accounts reflect the actual true nature of the transaction, its economic substance, rather than purely its legal form. There should be full disclosure and fair presentation. So full disclosure, all the information that a user of the accounts needs to make an informed decision needs to be disclosed in the accounts. And fair presentation, it should be understandable, and it should be, of course, consistent with treatment in prior periods. Comprehensiveness simply means the framework should cover all financial transactions. Now remember what we said, it's the accounting standards that detail exactly how you deal with transactions. Now of course that leads us to a danger that as new transactions occur, because we live in a dynamic world, we could have a transaction where there is not an accounting standard covering it. However, no fear, because we have that accounting standard framework that we just looked at. Now notice that second bullet point says this framework needs to be flexible enough to adapt to new transactions. So what this means is, even if there wasn't an accounting standard covering this transaction, by applying the principles and concepts from the financial framework, we should end up reporting the materiality and the economic substance of the transaction. Consistency, well, of course, once we choose to account for a transaction a specific way, and of course the specific way should be the one that shows its economic substance, then we need to present in a similar way across time. Now we've got to be a little bit careful here, because what we don't want to end up with is a prescribed set of rules where we're telling companies how to account for transactions. Why? We need the flexibility that the company can choose the accounting principles that represent the economic substance of the transaction. Now, of course, that always leads us into a conflict. If we establish a set of rules, then all companies are using the same rules, makes it easy to compare, but you're not necessarily seeing economic substance. If we give companies choices to choose the accounting policies that reflect economic substance, well, whenever there's choice, there's scope, of course, for stretching the accounting rules, or in the most extremes, fraudulent reporting. Barriers to a single framework. Well, these are some of the barriers that we still see. Historic cost. Now, we've seen that US GAAP typically relies on historic cost, with the exception of some financial instruments. Historic cost really means purchase price. So if you've got your plant, property and equipment sitting there at historic cost less accumulated depreciation, historic cost will be all of the costs in getting that asset into its condition and up and running. In other words, typically the purchase price. Now, fair value is typically what the asset is worth, either worth in the marketplace or the worth to the company as it uses it. Issue is, of course, unless the asset is traded in a secondary market, it's going to take considerable judgment to establish what fair value is. Now again, problem is, historic costs could be massively out of date and therefore not much use for economic decision making. Fair value essentially reports the cash flow generating ability of the asset, or what the asset could be exchanged for if it was sold, so it's far more relevant but far more subjective. Now again, IASB and FASB recognize that some elements should be measured at fair value. Again, remember, US GAAP typically says it should be only certain investments, and the ones we're going to see are available for sale passive investments and trading securities. International Accounting Standards has available for sale securities, trading securities, but also extends it as well into plant, property and equipment and intangibles, although you should be aware it says may for those. You may revalue. So principles-based. International Accounting Standards historically has been a principle-based led regime with very few specific rules. As a result, it relies on its conceptual framework a whole lot more than, let's say, US GAAP. The idea is you have few specific rules, giving the flexibility for companies to report economic substance. Rules-based. Well, of course, in the past, this has been what US GAAP followed. Now, it's very prescriptive and therefore aids comparability between companies. The problem is it's not necessarily flexible, and therefore you get companies reporting transactions but not reporting economic substance. Now, a classic example of this is the treatment of special purpose vehicles in the days prior to Enron. Now, prior to Enron, Essentially, you could set up a special purpose vehicle, make sure you weren't the majority shareholder, and because you weren't the majority shareholder, you didn't have to do consolidation. In other words, you didn't bring in its assets and liabilities separately into your accounts. Instead, you could get away with equity accounting, where you just brought in your share of its net assets. Remember, net assets being assets minus liabilities. Well, the issue with special purpose vehicles is very big asset figure, almost equally big liability figure, if not almost equally big liability figure, giving you very small net assets. So when you looked at Enron's accounts, you saw tiny amounts relating to its relating to its special purpose vehicles. However, the issue was Enron had cross-guaranteed the debt in the special purpose vehicles. So you weren't seeing the true liability position. Why? Because essentially they were following rules and not reporting the economic substance. Now, of course, post-implosion of Enron, that's all rather changed, and we'll look at special purpose vehicle accounting in the Level 2 syllabus. So US GAAP is now rather objective-based, combining both principles and rules, and I think we can say IFRS is here too, probably still a little bit more principle-based than US GAAP. Measurements. Let's just talk a little bit about those. Two potential approaches. Either you focus on the balance sheet, in other words, get the assets and liabilities correct, and then the income statement will just be the other side of the double entry bookkeeping transactions. Alternatively, you can go for an income statement approach where you get the revenues and expenses correct, i.e. the income statement is fairly presented, in which case the balance sheet will be the other side of the double entry. In other words, what we're really saying is you can focus on one but not the other. It's just the fundamental nature of double entry bookkeeping. You can't worry about both sides because debits and credits will have to equal one another. So if you focus on the balance sheet, the income statement becomes the other side of the accounting treatment, keeping it all balancing. If you focus on the income statement, then the balance sheet becomes the other side of the accounting transaction and keeping it all balancing. So, by definition, standards regarding one statement will have effects on the other. So, for example, lots of transactions will affect both the balance sheet and income statement. What we're saying is if the double entry, one part hits the balance sheet, one part hits the income statement, then by definition, any standard that affects one statement will have an impact on the other. Now notice, typically standard writers take an asset and liability approach. In other words, they concentrate on establishing that the balance sheet is reporting economic substance, and therefore the income statement, to a degree, becomes slightly an afterthought. Monitoring importance. Well, this just simply says, explain the importance of monitoring development. So why should we monitor the development of accounting standards? Simply because they change a lot and they change quickly. As I was saying, 20 years ago when I became a chartered accountant in the UK, the equivalent of a CPA, US GAAP and IFRS were completely different. These days, they're far more harmonized. In other words, the standard setters are changing and the standards themselves are evolving rapidly and changing and harmonizing. Now, why do we care about this as an analyst? Because, of course, we need to know how the accounts have been produced to ensure that we're comparing like with like when we're comparing companies, to ensure that we understand the economic substance of the transactions that are being reported. So, we need to monitor new products, new transactions, look to see if they're covered by accounting standards. If not, we need to go back to the framework, essentially, and work out how they should be accounted for. Now, of course, also we should review the actions of both standard setters, such as the International Accounting Standards Board and US GAAP, the Financial Accounting Standards Board, and also regulators such as the SEC, of course, and the FSA. Remember, these regulators are often looking after listed companies. Notice as well there, the CFA Center for Financial Market Integrity also monitors the development of accounting standards. Company disclosure, management discussion, analysis, and footnotes. Every time companies change their accounting policies or revise estimates that they're using in the accounts and judgments, it has to be disclosed in both the management discussion, analysis, and footnotes. In fact, in the very first footnote you tend to see, it sets out all of the key accounting principles that the company is using to report transactions in its financial statements. And as I said, if they have changed, whether voluntarily changed or involuntary because the accounting standards themselves have changed, it will be disclosed in these documents. Company disclosures. Analyze company disclosures. Well, we said, look, there's two sources of importance here. Number one, they're telling you the accounting principles that the company has chosen and why. Number two, it's highlighting key estimates and judgments used in preparing the accounts. And number three, it's giving you additional information on the information that you see on the face of the primary financial statements. Remember, we've got minimal disclosure in the primary statements. We've got additional disclosure, fleshing them out in the footnotes. Okay, let's take some of these bullet points in turn then. So we're certainly going to see critical and significant accounting policies affecting material balances in both the income statement and the balance sheet. So, for example, the company will set out what revenue recognition techniques it uses, what depreciation policies it follows, etc., etc. Accounting estimates. It's going to set out the accounting estimates that essentially it uses in the accounts. Now, this is a key point because what we're really simply saying here is there are lots of subjectivity and estimates going on in a set of accounts. The reason for this is the accruals process. So, for example, remember what we said. At year end, you've got your accounts receivable. You know you're not going to collect all the cash from the customers because some will default. So we have to estimate how much we're not going to collect and deduct it from accounts receivable and put it as an expense in our income statement. What other accounting estimates do we see? Well, we're going to encounter tons of them as we go through the CFA syllabus. We're going to look at valuing inventory. We're going to look at depreciation policies. At level 2, we're going to encounter things like pension accounting. The key is there are lots of estimates and judgments. It's very important that we start moving away from this idea that the accounts are hard and fast fact and towards the idea that there's lots of estimates and judgments going on. Why do we need them? Well, so that the company can report economic substance. But remember, the flip side of that is accounting estimates, essentially in judgments, could be manipulated to manipulate the accounts themselves. Now, of course, they'll also need to detail changes in accounting policy, as we mentioned in the previous learning outcome statement. And also we get footnote disclosure and discussion in the management discussion and analysis. So again, what we're really simply saying here is not only do you get detailed accounting policies, estimates and changes discussed in the or listed in the footnotes, you're going to see discussion of why the company chooses those accounting policies, why they've changed their accounting policies in the management discussion and analysis. Again, remember one caveat to that, it isn't audited. So what do we need to focus on? Well, what policies have the company discussed? Do the policies they're discussing cover all significant transactions? If you can spot a significant transaction and the company is not telling you how they account for it, immediately your alarm bells should be ringing. Are they reporting its economic substance? Which balances require significant estimation? In other words, what balances are relatively hard and fast fact, where what balances are very, very subjective indeed? And of course, have there been changes? Remember, changes to accounting policy will be discussed in the management discussion and analysis. Changes in accounting policy will cause the company to restate prior financial years. Changes in accounting estimates do not require the company to restate prior years. In other words, the only place you're really going to pick up on them is by analysing the footnote disclosure and the management discussion and analysis.